Welcome back to the deep dive. This is where we take, those hundreds of pages of dense financial reports, all the footnotes, the jargon, the inflation adjustments, and we try to pull out the really key strategic insights, the actionable stuff that matters to you, the individual investor.
And today, we're digging into Pinar Suit Mamuleri Sanai Aish. We're looking specifically at their performance for the first 9 months of 2025. It's a really revealing period, especially because they're operating under Turkey's hyperinflation accounting rules, TMS 29.
Right, TMS 29. So we're not just looking at nominal lira figures, we're looking at figures adjusted for purchasing power, which makes it a whole different ballgame.
Exactly. It's essential for getting a true picture. So our goal today is to quickly synthesize these complex reports, the activity report, the financials, to really get a handle on the company's health, where the risks are building up and what big strategic moves management made.
We're hunting for those aha moments, the insights that help you make informed decisions without you having to spend days wading through the details. We really want to respect your time.
And we'll be focusing particularly on operational performance, how they're managing their debt, and this is crucial for Pinar Suit, the huge role of related party transactions. You really have to see this company as part of the wider Yashar group.
Okay. So if you find this kind of deep dive analysis valuable, getting the key takeaways without the headache, please do us a quick favor. Like this deep dive, subscribe to the channel if you haven't already, and maybe share it with someone else who's trying to track the Turkish food sector. Right. Let's get started. Let's lay the groundwork. Who is Pinar Suit? Let's just unpack the basics first. Pinar Suit, big name, been around since '73. The Pinar brand is everywhere in Turkey. But what's their core business exactly, and where do they operate from?
Yeah, they're definitely a household name. Their main business is dairy milk, cheese, yogurt, the whole range. But they also do fruit juices, various sauces, even some powdered products. Operationally, their headquarters are in Izmir, specifically Bornova.
Okay, Izmir-based.
Right. But the manufacturing happens in 3 main plants. One in Izmir Pınarbaşı, another in Eskişehir's organized industrial zone, and a third one down in Şanlıurfa, also in an OIZ.
And the reports make a point of saying there are no external branches or other non-central operations. That sounds like a pretty tight, centralized structure despite having those 3 plants.
It is, operationally. But where the centralization really hits you is in their sales and distribution. This is probably the first really critical thing an investor needs to grasp about Pinar Suit.
Okay, lay it on us. How centralized are we talking?
We're talking profound dependency on other Yashar Group companies. Let's look at domestic sales first, 92%. 92% of their net domestic sales go through one single related entity, Yashar Birleşik Pazarlama, or YBP.
92%? Wow, okay, so almost everything they sell in Turkey goes through YBP. What about exports?
Even more concentrated, 100%. All their international sales and distribution are handled exclusively by another group company, Yashar Diş Ticaret, YDT.
So 100% international through YDT, 92% domestic through YBP. That's an incredible level of reliance on the group's distribution network.
It is. I mean, it guarantees them market access, scale, efficiency in some ways. But it also means Pinar Suit's sales performance is completely intertwined with the operational health and financial stability of YBP and YDT. You're not just betting on Pinar Suit making good yogurt.
You're betting on the whole Yashar distribution chain working smoothly.
Got it. That definitely puts those related party transactions we mentioned earlier right at the center of the picture. Okay, let's shift to the corporate structure itself. Who owns Pinar Suit, and were there any big structural changes recently?
Ownership is pretty straightforward. Yashar Holding Esh is the dominant shareholder, holding 61.45% as of the end of Q3 2025. The public float, traded on Borsa Istanbul, makes up the other 38.00%. Those are the C Group bearer shares. So Yashar Holding is firmly in control.
Okay, stable ownership. But I saw something about the registered capital ceiling. It looked like a massive change. Oh, absolutely massive. That was a really eye-catching move. Back in March 2025, they amended their Articles of Association to increase the registered capital ceiling.
Increase it by how much?
It went from 80 million Turkish lira all the way up to 15 billion Turkish lira.
15 billion, with a B. That's astronomical. But their actual issued capital didn't change, right? It stayed around 315 million TL.
That's correct. Issued capital remained constant. So why make such a gigantic increase to the ceiling, the authorized limit?
Yeah, what's the thinking there?
It signals immense future flexibility. Management basically got shareholder approval in advance for potentially huge capital increases down the road. Think major acquisitions, significant internal restructuring, or just having the power to raise substantial equity quickly if needed without going back for approval each time.
So it's like building a massive reservoir of potential capital, even if they haven't filled it yet, pre-authorizing future moves.
Precisely. It gives them maximum room to maneuver financially in what's obviously a very dynamic, high-inflation economy.
Okay, interesting strategic positioning. Now let's look at the board. 9 members. Anything stand out in the composition or the committee structures, especially thinking about that distribution concentration we just talked about?
Yeah, the board composition is quite notable, actually. There's significant female representation. 5 out of the 9 board members are women.
5 out of 9. That's over half.
It is. And that includes both the chair, İdil Basha, and the vice chair, Emin Fehan Yashar. What's also really key is that all 3 independent board members are women. Sekin Chinol, Sidin Balshe, and Nalaner Karakash.
All 3 independent directors. That's important, right? Especially given how intertwined the company is with Yashar Holding and YBPYDT. You need strong independent oversight.
Absolutely critical. And these independent directors aren't just names on a list. They hold key positions on the crucial oversight committees. We're talking about the Audit Committee, the Corporate Governance Committee, and the Committee for Early Risk Detection.
So they're embedded in the core control functions.
Exactly. Their presence across these committees is vital. They're the mandated check and balance, providing that essential independent scrutiny, particularly important when you have billions of lira flowing between related parties, like we see with the sales to YBP. It helps ensure things are done fairly for all shareholders, including the public ones.
Makes sense. Okay, let's turn inward now. What about the people running the company day to day? Personnel numbers and executive compensation. What did the 9M 2025 figures show?
On a personnel side, the average number of employees during the first 9 months of 2025 was 12,244. That's actually a small decrease from the end of 2024 when they reported 12,277.
A slight dip, maybe streamlining operations, finding efficiencies.
Could be. It's not a huge drop, but it suggests maybe a tighter ship or perhaps just natural attrition not being fully replaced. Now, executive compensation. This is interesting, especially because these figures are inflation-adjusted under TMS 29. We're talking real purchasing power here.
Right, so what happened to the real pay for senior execs?
It went down. Total short-term benefits, think salaries, bonuses paid to senior management, decreased from 72.5 million TL in the first 9 months of 2024 to 58.4 million TL in the same period of 2025. That's a noticeable drop in real terms.
Over 14 million TL less in real terms for the top brass.
Yeah, and long-term benefits saw a decrease too, although the amounts are smaller. Went from about 861,000 TL down to 287,000 TL.
So overall, less compensation going to the senior team, even after accounting for inflation eating away at the lira's value. Why would that happen? Especially when, as we'll get to, the company actually managed to reduce its losses significantly.
It's a bit counterintuitive, isn't it? Usually you might see pay rise nominally just to keep pace. A real decrease suggests a couple of things might be happening. One, it could be part of a deliberate, company-wide cost control push, with management leading by example.
Setting the tone from the top.
Exactly. 2, maybe performance targets linked to their compensation weren't fully met in the prior period, impacting the bonuses paid out this period. Or perhaps the targets themselves were very demanding, given the hyperinflationary context. Even though the net loss shrank, maybe other specific profitability metrics used for bonuses didn't hit the mark in real terms.
So it reflects either active cost-cutting discipline or the real impact of inflation on hitting specific financial targets. Either way, it shows a level of financial restraint at the executive level.
It definitely does. It contrasts sharply with what you sometimes see, where executive pay balloons even when overall performance is shaky. Here, it seems aligned with the push for financial stabilization.
Okay, let's dive into the core financial performance now. And just to remind everyone listening, all the figures we're discussing are inflation adjusted to the purchasing power of the lira as of September 30, 2025, using the TMS 29 standard. It's the only way to make meaningful year-over-year comparisons.
Absolutely vital context. Without it, the nominal growth would look very different and, frankly, misleading. We need to see the real performance.
Right. So, starting at the top revenue, how did Pinar Suits sales hold up in real terms in the first 9 months of 2025 compared to 2024?
Well, the net sales figure came in at 12.08 billion TL for 9M 2025. That's actually a decline in real terms compared to the 12.76 billion TL they posted for 9M 2024.
So a bit of a drop. Around 700 million TL less in real revenue. Did gross sales show the same trend?
Yes, same direction. Gross sales went from 16.65 billion TL down to 15.72 billion TL. So across the board, a slight contraction at the top line when you adjust for inflation.
They did mention selling about 207,000 tons of product. Unfortunately, the report didn't give a tonnage comparison for last year, which makes it hard to see if the revenue drop was due to selling less volume or just prices not keeping up with inflation.
That's a common challenge with these reports. But the implication of falling real revenue alongside significant tonnage is likely that price increases, while probably substantial in nominal terms, just couldn't fully offset the incredibly high rate of inflation impacting costs and the overall economy. The real value extracted per ton might have slipped.
Suggests tough competition, maybe consumer price sensitivity, or perhaps regulatory pressures limiting how much they could pass on.
All plausible factors in the Turkish market. On a more positive note for them, their export sales remained pretty solid. They reported 22.77 million US dollars in export value for the period.
Okay, nearly $23 million. That's important hard currency income, especially given the lira situation.
Definitely. It provides a valuable, albeit partial, buffer against domestic economic pressures and currency fluctuations. But here's where the story gets really interesting. Despite that slight dip in real revenue, their margins improved significantly.
Okay. This is where the efficiency story comes in. Tell us about the margins.
Big improvements here. Let's start with gross profit margin. It jumped from 8.5% in 9M 2024 up to 10.1% in 9M 2025. That's a solid increase.
Over a 1.5 increase in gross margin. What about operating margin?
Operating profit margin also improved, though it stayed negative. It went from -1.6% up to -0.8%, so they cut the operating loss margin almost in half.
Still losing money at the operating level before financing and inflation effects, but much less so. And the bottom line, net profit margin.
That showed the most dramatic improvement. It went from a deeply negative, -8.4% in 9M 2024, all the way up to -4.0% in 9M 2025. Still a net loss, but the margin of loss more than halved.
Okay, so revenue down slightly in real terms, but gross, operating, and net margins all significantly better. How does that work? Why would margins improve if you're bringing in less real revenue? Is it just a mix effect, selling less low-margin stuff, or is it genuine operational improvement?
That's the key question. While mix could play a small part, the scale of the improvement, especially in gross margins, strongly suggests genuine gains in operational efficiency and maybe cost management. Think about it in hyperinflation. Managing your working capital is paramount.
Like how quickly you turn raw milk into cheese on the shelf and get paid for it.
Exactly. If they got better at managing inventory levels, maybe negotiated better input costs relative to their sale prices before the next inflation hike hit, or simply became much faster and leaner in their production cycle, that directly boosts gross margin. It suggests management did a good job controlling the things they could control within the factory gates.
So tighter operations, better cost control, maybe smarter purchasing and pricing cycles relative to inflation. That makes sense.
It points to a resilient core manufacturing operation. Now, let's look at how this filtered down to the absolute profit figures.
Right, the bottom line itself. What was the big news there?
The really crucial takeaway for anyone tracking this company is the dramatic reduction in the net period loss. As we saw in the margin improvement, the absolute loss shrunk significantly. It went from a huge loss of 1.07 billion TL in 9M 2024 down to 486.3 million TL in 9M 2025.
So they cut their net loss by over $500 million lira. That's a massive improvement. But we need to be careful about how they achieved that, right?
Yeah.
It wasn't just those operational margin gains. There was a big accounting factor at play due to TMS 29. Precisely. A very significant portion of that bottom line improvement came from something called the net monetary position gain. This is a specific feature of hyperinflation accounting.
You explain that gain. How big was it, and why does Pinar suit benefit?
It was huge this period. It jumped from 353 million TL in 9M 2024 to nearly 729 million TL in 9M 2025. Basically, TMS 29 requires companies to calculate whether they hold more monetary assets, like cash, receivables, or monetary liabilities, like loans, payables.
Okay.
Pinar suit holds significantly more monetary liabilities than assets. Think of all their bank borrowings. As hyperinflation rages, the real value of the lira they will eventually use to repay those debts decreases. The net monetary gain is the accounting recognition of that decrease in the real burden of their net monetary liabilities.
So because they owe a lot of money and the value of that money is eroding rapidly due to inflation, the accounting rules give them a non-cash gain on their income statement.
That's a good way to put it. It's a non-cash accounting entry that reflects the economic reality of their debt burden shrinking in purchasing power terms. It provided a massive tailwind to their net income, boosting it by almost 730 million TL this period. Without it, the net loss would have been much larger, despite the operational improvements.
That's a critical distinction. It's not cash earned from selling products, it's an accounting adjustment reflecting the impact of inflation on their debt load. So we need to look at the profit before that adjustment, too. How did their core operating profit, the İsa'z Faaliyet Karı, fare?
Encouragingly, that did show improvement too, though more modest. It rose from 164.9 million TL in 9M 2024 to 176.3 million TL in 9M 2025. So the underlying business operations generated slightly more profit before financing and the big inflation accounting effects.
Okay, so some genuine operational improvement there, supporting the margin story. What about financing costs? They managed to reduce their interest burden?
Yes, net financial expenses were lower. They dropped from 2.19 billion TL down to 1.87 billion TL, so about 320 million TL saved there, which is helpful.
Lower interest payments, presumably due to maybe lower debt levels or better rates?
Could be a mix. However, that saving was partially offset because their financial revenue also dropped quite significantly. It fell from 774 million TL down to 475 million TL.
So they earned less from financial activities, maybe lower interest earned on cash, or perhaps less income from loans to related parties.
That's possible. It points towards changes in how they're managing cash and intercompany financing. And that leads us nicely into looking at the balance sheet itself, the capital structure, debt levels, and the overall financial risk profile.
Right. Let's start with liquidity. How does their short-term health look? Are they able to cover immediate bills?
The picture here is tight but slightly improving. Let's look at the current ratio that's current assets divided by current liabilities. It edged up from 0.8 at the end of 2024 to 0.9 as of September 30, 2025.
Still below 1.0, though. That generally signals potential difficulty in meeting short-term obligations with readily available assets.
Exactly. A ratio below 1 means current liabilities exceed current assets. It implies they rely heavily on generating cash very quickly from inventory and receivables to pay their immediate bills. The acid test ratio, which excludes inventory, also improved slightly from 0.6 to 0.7. Still quite low.
So liquidity is a pressure point, definitely something to watch. What about the overall debt structure? Did they manage that effectively?
This is actually one of the big success stories of the period, arguably. While total financial debt didn't change drastically, it decreased slightly, the composition of that debt shifted dramatically and favorably.
How so?
They significantly reduced their reliance on short-term borrowings. Short-term debt, including the current portion of long-term debt, fell from 5.78 billion TL down to 4.47 billion TL. That's a 1.3 billion TL reduction in immediate pressure.
Okay, where did that pressure go?
It was shifted into the future. Long-term borrowings exploded, jumping from just 200 million TL up to 1.11 billion TL.
Wow, a five-fold increase in long-term debt while short-term debt dropped significantly. That looks like a very deliberate and successful debt reprofiling exercise.
Absolutely.
Yeah.
They effectively pushed over £1 billion lira of debt repayments further down the road. This dramatically eases near-term cash flow pressure and gives them significant breathing room financially. A major win for stability.
Definitely buys them time. However, you mentioned foreshadowing earlier. Was there a negative counterpoint to this debt success?
There was, and it's a big one. Foreign currency exposure. This is where the risk profile took a sharp negative turn during this period.
Uh-oh. What happened with their FX position?
We completely flipped it.
Yeah.
At the end of 2024, Pinar's suit actually had a net asset position in foreign currency, meaning their FX assets slightly exceeded their FX liabilities by about 159 million TL, a small positive buffer.
Okay, that sounds prudent.
But by September 30, 2025, they had swung to a massive net FX liability position of 1.71 billion TL.
A 1.7 billion lira short position in foreign currency. That's a huge swing. How did that happen? More foreign currency loans?
That would be the primary driver, yes. Taking on more debt denominated in euros or dollars while perhaps holding fewer FX assets. This dramatically increases their vulnerability to any further depreciation of the Turkish lira.
So if the lira weakens, that 1.7 billion TL liability becomes even larger in lira terms, hitting their bottom line and equity directly. Did they quantify that risk?
They did in their sensitivity analysis. They calculated that a 10% depreciation of the lira against the US dollar would cause a loss of about 119 million TL. And a 10% drop against the euro would cost them around 52 million TL.
Significant hits from just a 10% currency move. Given the ongoing volatility in the Turkish economy, that 1.7 billion TL net FX liability looks like a major flashing red light for investors.
It's arguably the most significant new financial risk that emerged during this period. Managing that exposure will be absolutely critical for them going forward. It overshadows some of the other positive developments on the debt maturity front.
Okay, we've covered the income statement, the debt, the FX risk. Now let's look at assets. Where did Pinar invest its money? And were there any significant movements on the asset side of the balance sheet? Let's start with CapEx.
Sure. Total capital expenditures for the first 9 months of 2025 came in at 265.5 million TL. It wasn't massive spending, but the allocation's interesting.
Where did it go?
The largest chunks were 109.7 million TL for machinery and equipment, keeping the plants running and maybe updating some lines, but also a pretty substantial 144.1 million TL on intangible assets.
Intangibles like
Right.
software, patents, brand value. That's more than they spent on physical machinery.
Exactly. It could be investments in new IT systems for efficiency, maybe software licenses, potentially brand development or R&D capitalization. It suggests a focus not just on maintaining physical capacity, but also on improving processes, systems, or maybe future product development, a longer-term efficiency play.
Interesting. While they were making those investments, what was happening to their existing fixed asset base, the Mati Duran Varlik?
Overall, the value actually decreased. The net book value of tangible fixed assets went down from 12.0 billion TL at the end of 2024 to 11.2 billion TL by the end of Q3 2025. So an 800 million TL net reduction.
Depreciation would account for some of that, but was there a specific large disposal?
Yes, the report highlights a significant outflow, specifically 479 million TL related to land assets. But this wasn't just selling off random plots. It seems tied into a series of related party transactions and financial restructuring moves.
The related parties again. So asset disposals were linked to internal group movements.
Very much so. This period saw some significant portfolio shuffling within the Yashar Group involving Pinar. They essentially used some of their investments in other group companies to generate cash.
What did they sell?
They sold 2 key holdings back to the parent company, Yashar Holding. First, their entire 12.58% stake in Pinar S, the meat processing sister company. Second, a 6% stake they held in Desa Energy.
Selling stakes in related companies back to the holding company. How much cash did that bring in?
Those two sales combined generated 387.7 million TL in cash inflow for Pinar, a significant injection of liquidity.
Okay, nearly 400 million TL cash raised. What did they do with that cash? Did it just shore up the balance sheet, or was it deployed elsewhere?
It was almost immediately redeployed again within the group. They used 386.8 million TL, basically all the cash they just raised, to buy more shares of their key domestic distributor, YBP, also from Yashar Holding.
Wait, so they sold stakes in Pinar et and Desa Energy to Yashar Holding and then used that exact money to buy shares in YBP from Yashar Holding.
Precisely. It looks like a carefully orchestrated internal asset swap. This purchase increased Pinar ownership stake in YBP to 40.05%.
And hitting that 40% level probably has accounting implications too, right?
Yes, crossing that threshold likely solidified its classification as an investment accounted for using the equity method. But strategically, the message is clear. Pinar divested from non-core group assets, meat and energy, to double down on its control and financial stake in the company that handles 92% of its domestic sales.
It's tightening the grip on that absolutely critical distribution channel, using internal resources to secure the pathway for the vast majority of its revenue. Defensive, but makes sense given the concentration risk.
Exactly. It reduces the risk associated with relying on YBP by becoming a more significant owner of YBP. It locks down that channel.
Okay, that explains the asset movements. Now let's get back to the engine room cash flow. You mentioned earlier that despite improved margins, operating cash flow was negative. Let's dig into that. How bad was it and why?
Yeah, this is arguably the most concerning financial metric for the period. Cash flow from operations, OCF, was negative 188.1 million TL for 9M 2025.
Minus 188 million from core operations. And how does that compare to last year?
It's a huge dramatic reversal. In 9M 2024, they had generated a positive OCF of 430.2 million TL. So they swung from positive 430 million to negative 188 million, a swing of over 600 million TL in operational cash generation.
That's a massive deterioration. What was the main culprit? If margins improved, why did cash flow collapse?
The cash flow statement makes it pretty clear. The single biggest drag was a massive increase in working capital tied up in receivables. The adjustment for changes in trade receivables was a negative 1.07 billion TL.
A billion lira tied up in unpaid invoices.
Essentially, yes. And when you look at the footnotes detailing related party transactions, the picture becomes crystal clear. There was a 1.2 billion TL increase, specifically in commercial receivables from related parties.
There it is again. So YBP and maybe YDT, the distribution companies, are taking much, much longer to pay Pinar Suit for the products they're selling.
That's exactly what it points to. Pinar Suit is producing and shipping goods, booking the revenue, showing improved margins on paper, but the cash isn't coming back from its main related party customers nearly as quickly.
So Pinar Suit is effectively financing the working capital needs of its own distribution network by letting receivables balloon.
It certainly looks that way. The operational gains are being absorbed by this working capital strain within the group. It's a major drain on Pinar Suit's own liquidity.
Okay, so negative OCF is a big red flag. But how did the overall cash balance end up? Did investing or financing activities offset this operational drain?
They did significantly. Cash flow from investing activities, ICF, was strongly positive, coming in at 1.16 billion TL. This is another huge swing from the previous year where ICF was negative 638 million TL.
Positive 1.16 billion from investing. Where did that cash come from?
It came directly from those asset transactions we just discussed. The sale of the Pinar S and Dessa Energy stakes brought in nearly 400 million. And critically, there was a large inflow from the sale of fixed assets, 567.5 billion TL.
Sale of fixed assets. Who bought them?
The footnotes reveal most of it was, again, a related party. Specifically, 542.5 million TL of that inflow came from selling fixed assets to YBP.
So YBP bought fixed assets from Pinar Suit, generating cash for Pinar Suit, while Pinar Suit's receivables from YBP were soaring.
Yes, it paints a picture of significant internal cash movements designed to manage liquidity across the group. Pinar Suit generated substantial cash by selling assets, primarily internally.
Okay, so positive ICF offset the negative OCF. What about financing cash flow, FCF, debt repayments and issuance?
Financing cash flow was strongly negative, at negative 711.6 million TL. This reflects that the cash they generated from asset sales wasn't just sitting there. A good chunk was used to pay down debt principal, exceeding any new borrowings taken on during the period.
Which aligns with the reduction in short-term debt we saw earlier. They use asset sale proceeds to execute that debt reprofiling.
Exactly. It all ties together. So if you net it all out, negative OCF, 188M, was more than offset by positive ICF, plus 1.16B, and then cash was used for net debt repayment via FCF, negative 712M. The end result.
What was the net change in cash?
Despite the operational cash burn, the overall cash and cash equivalents balance actually increased. It went up from 58.6 million TL at the start of the year to 323.7 million TL at the end of Q3.
So they ended the period with more cash, thanks entirely to those asset sales and internal transactions, managing to plug the gap left by the struggling operating cash flow. It feels like a very complex juggling act. It's highly coordinated financial management, heavily reliant on intragroup transactions. Which brings us back, finally, to really nailing down those critical related party exposures and commitments.
Right. We've touched on sales concentration and receivables. Anything else we need to highlight?
Well, just re-emphasizing the scale over 12 billion TL in sales flowing through YBP and YDT. But beyond the trade receivables, there are also significant non-trade receivables from related parties.
Non-trade. What are those?
These are balances listed under other receivables, primarily from Yashar Holding itself and another entity called HDF FZCO. They total a hefty 1.26 billion TL. The notes indicate these relate to debt transfers and interest accruals.
So more internal group financing flows, essentially Pinar Suit lending money or having debt assigned to it within the group, accruing interest. What kind of interest rate are we talking? The effective annual interest rate on these receivables was stated as 47.85%. That's high, reflecting the overall interest rate environment in Turkey, though it was actually down slightly from 54% previously. It confirms Pinar Suit is acting as a significant financial conduit within the Yashar Group structure.
Okay, so high dependency for sales, high receivables, both trade and non-trade. But you mentioned support flowing the other way too, guarantees.
Yes, and this is a really crucial counterbalancing factor. While Pinar Suit is exposed through receivables, it's also receiving massive financial backing from the group. The amount of third-party guarantees and sureties provided by Yashar Holding and YBP to support Pinar Suit absolutely soared.
How much are we talking?
It jumped from 273.7 million TL at the end of 2024 to 1.04 billion TL as of September 30, 2025.
£1 billion in guarantees received from the parent and main distributor. That's nearly a four-fold increase.
Exactly. This is explicit financial backing. Yashar Holding and YBP are putting their own creditworthiness on the line to guarantee Pinar Suit's obligations or facilitate its borrowings. It significantly enhances Pinar Suit's perceived stability and access to external finance.
So while the receivables from the group are a risk, the guarantees from the group are a major source of strength and mitigate that risk somewhat.
It's a critical trade-off. The group is essentially saying, yes, you're financing some of our working capital through receivables, but we are explicitly backstopping you with over £1 billion in guarantees. It shows how integrated and mutually dependent they are.
And did Pinar Suit's own guarantees given change? The TRSHA disclosures?
Yes, interestingly, the total collateral, pledges, and mortgages given by Pinar Suit related to its own operations actually decreased. They went down from 727 million TL to 409 million TLs, mostly standard bank letters of guarantee in lira and USD.
So they managed to secure way more guarantees from the group while simultaneously reducing their own guarantees given out.
That combination really underscores the coordinated effort. The group structure is being actively used to bolster Pinar Suit's external financial standing, likely recognizing its core importance and maybe mitigating concerns raised by the negative OCF and the new FX risk. Hashtag tag outro. Okay, so let's try to pull all these threads together for the individual investor looking at Pinar Suit's 9M 2025 results. It's definitely a mixed and complex picture. On the one hand, you have to give them credit for navigating the hyperinflationary environment pretty effectively.
Yeah, cutting that net loss nearly in half is a major achievement on the surface. And the improvements in gross and operating margins point to real strength in the core manufacturing operations, better efficiency, cost control.
Absolutely. And the successful debt restructuring, shifting that billion lira from short-term to long-term, was a very smart move, buying crucial time and easing immediate financial pressure. The strategic asset sales, selling 8 in energy to buy more of YBP, also shows decisive action to secure their main sales channel.
Now, there are some significant buts, aren't there?
There are. That tight liquidity, with the current ratio still below 1.0, remains a concern. The business isn't generating enough readily available assets to cover its immediate liabilities without very efficient management.
And the biggest but seems to be the cash flow situation. That massive negative swing in operating cash flow, driven almost entirely by the surge in receivables from related parties. That's worrying.
It is. It suggests the operational profits aren't translating into actual cash in the bank because it's getting tied up within the group's distribution arm. Relying on asset sales, even internal ones, to fund operations and debt repayments isn't sustainable in the long run.
And then there's the new elephant in the room, that huge 1.7 billion TO net foreign currency liability. That introduces a whole new layer of risk tied directly to the lira's exchange rate.
Exactly. So improved margins and bottom line, yes. Better debt maturity profile, yes. But offset by strained operating cash flow, high related party receivables dependency, and significant new FX risk.
What really stands out to me from this whole analysis is just how fundamentally Pinar Suit's financial health is interwoven with the broader Yashar group. It's operating almost like a division within a larger machine, with significant capital and cash flowing back and forth through these related party transactions.
That's the core reality here. You can't analyze Pinar Suit in isolation. Those internal group maneuvers, the asset swaps, the receivables buildup, the massive guarantees are managing risk and financing working capital across the system. Pinar Suit is both a producer and a key part of the group's financial plumbing.
So for you, the listener, the key focus has to be on the sustainability of this model. Can Pinar Suit translate these operational efficiencies and the breathing room from debt restructuring into generating strong, positive operating cash flow on its own? Or will it continue to rely heavily on group support and internal financial engineering?
That's the billion lira question, isn't it? The dependence needs to lessen over time for true standalone financial health.
Which leads us to our final provocative thought for you to consider. We've seen Pinar Suit successfully manage its debt maturity and secure massive guarantees from its parent. Now, what concrete external investment projects or operational initiatives will management prioritize to turn these defensive financial maneuvers into sustainable, positive operating cash flow? How will they start generating enough cash internally to reduce reliance on these intra-group flows and truly capitalize on their market position independent of the parent's financial choreography?
The answer to that will tell us whether this period was just stabilizing the ship in a storm or if it's setting the stage for genuine independent growth ahead.
Keep an eye on that OCF and the related party balances. That's where the story will unfold. Thanks for joining us for this deep dive into Pinar suit. If you found this valuable, please remember to like, subscribe, and share. We'll see you next time.